Less than 30 minutes until the start of trading, and futures are down. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
It's the big story. U.S. inflation cooling broadly in June, adding to a case for a September rate cut.
Plenty of single stock stories and action this morning after Delta's outlook mix. Pfizer's weight loss breakthrough is interesting as well.
And of course, here come the big banks set to kick off earnings season tomorrow. The Wall Street earnings parade beginning tomorrow. But let's take a look at these markets right now. It was interesting. We had that blockbuster CPI print, actually a contraction in CPI month over month. You saw S&P 500 futures spike pre-market, but taking back those gains right now, currently down 0.1%. Same story if you look at big tech. The Nasdaq 100 index currently lower in the pre-market. What is holding on to its gains is the bond market. That 10-year Treasury yield currently lower by about 9 basis points. Matt, just absolutely dropping like a stone.
All right, I'm taking a look at really stealing one of Torsten Slok's charts this morning, taking a look at the number of companies that outperform the S&P over time. And this really shows the narrowness of the market. Only 22% of companies are outperforming the S&P after we've had 37 all-time record highs this year. That's the second most this century after 2021.
And there's some stocks I'm watching, Matt. Absolutely a brutal start to earnings season here. Delta Airlines down now more than 9%. Pre-market, leading travel stocks lower. Remember, fare discounts, higher costs have offset the number of summer travelers Delta is feeling. One of many stocks to watch this morning in earnings season.
All right, CPI data out as well in the last 30 minutes. Let's get over to Michael Mckee, Bloomberg Chief Economics and Policy Correspondent, to give us the good news, Mike.
Yeah, it is good news, and it probably gives the Fed a lot more confidence, Matt, about the possibilities for a September rate cut, certainly giving the markets more confidence. As Katie mentioned, we saw a 0.1% contraction in headline CPI after flat last month, so 2 months in a row of basically no inflation in the overall CPI. The headline goes down to 3.0% on a year-over-year basis. And core, which the Fed's going to focus on, up just 1/10. That's the lowest in some time. And the core year-over-year, 3.3%. Super core comes in down 0.5% after down 0.4 the last time. So we're really seeing some progress against inflation here. The biggest contributors, gasoline, which is kind of always the case lately, and now the IAEA says demand is still falling, down 3.8%. Motor vehicle insurance, the one thing that rebounded, up 0.9%. And this explains Delta. Delta kind of getting out ahead of the CPI, but airfares falling 5% during the month. The biggest story, though, is owner's equivalent rent. The Fed's been waiting for housing prices to come down. They're now rising at the slowest pace since the fall of 2021, and that is going to be very good news for Fed officials who are, at this point, perhaps a lot more confident that inflation is going to stay at a lower level. That's what they've been looking for. And the big takeaway I have, guys, is that so many things were up only 1/10 or down 1/10. It really is a broad decline in the rate of inflation, and that's what the Fed has been waiting for.
But not sufficiently confident, right, Mike? That's what we heard from Powell yesterday.
Yes, well, I think if you put him in a room quietly by himself, he might say he's sufficiently confident. But of course, the issue the Fed always has is how much do you lead the markets? Because as the wise man said, the Fed has a reaction function. The markets have an overreaction function. What I think you'll get now is no change in July, but a sentence that basically says if this continues, we're going to be able to start rate cuts, and everybody's going to take that to mean September, and then we'll get more hints as people speak along the way.
All right, Mike, thanks very much. Michael Mckee there talking to us about the economic data, the data-dependent Fed, watching this number very closely. Again, inflation came down 0.1% month over month. So in terms of CPI, at least, that's pretty good news. Joining us now is Liz Young-Thomas, head of investment strategy at Sofi. And Liz, what does this data mean to you? I mean, is it a lock now for a rate cut in September?
Well, the Bloomberg warp function tells you that there's a 92% chance baked into the futures market now for a cut in September. I do think they will start to cut in September. There's been some narrative about whether or not they would do 50 to start off. I am not in that camp. I still think that they'll start with 25 so as not to scare anybody and do something much bigger than markets are expecting. Obviously, there's a lot of time between now and September, and we're going to hear from Powell at the next meeting. We're also going to hear from them at Jackson Hole. So a lot of things can change. We'll get 2 more CPI prints before that meeting even goes live. So the data is going to be interesting to watch over the next couple months. But here's what I would say about today's data. Obviously, that negative month-over-month print was a surprise for the market. A welcome surprise in some ways, because for a long time, we have been talking about needing prices to actually come down, not just stop growing as fast. So up until this point, we have had inflation still growing, just growing at a slower pace, and the absolute level of prices hasn't come down. So some of that takes pressure off of consumers, especially if we expect that trajectory to continue. However, what I think we're seeing right now in these choppy futures markets for equities is the question about whether or not this is too cool. So We've been cheering this cooler data for a long time. And now are we starting to worry, oh, wait a minute, it got too cool too fast. And I think that's what's going on in the futures market.
Well, Liz, not to risk making too much out of 30 minutes of movement, but does that help explain what we're seeing in the futures market right now? Because as I mentioned, you had futures on the S&P 500 spike and now come back down. We're currently just about unchanged. It's only the bond market that's held the move. Are we starting to see a little bit of that shift into worrying about growth?
I think it's undecided. I think investors are undecided at this point. Look, inflation is still running at 3% headline, and 3.3%. That's not something that shows us that there's this concerning slowdown yet in the economy. But if we're worried about consumers pulling back too much, that would affect revenue for companies. This is one of those times where, okay, the Fed is going to cut rates. We've been clamoring for cuts. Is it actually a good thing, though? And I think that's what markets are really dealing with. Once they start cutting rates, here's an important point to think about. I know today was CPI day, but the labor market is also really important. Once they start cutting rates, they will likely be cutting into a cooling labor market, not a strengthening labor market. And equity markets are going to have to reconcile that with whether or not that means that prices should still be rising, especially at a time when prices are at these levels. We've got a PE ratio in the 86th percentile of historical periods for the S&P. So does a cooling labor market justify much higher prices in equities? And I think that's what investors are grappling with. Right now, it's tough to say that it does.
Liz, I want to also bring in some of the news that's just been breaking across the wire a few minutes ago here, that Envestnet has agreed to be acquired by Bain Capital and other private equity companies here at a price of $63.15 per share. Yesterday it closed at $61.70. I think also it draws a bigger question. What are the catalysts for this market? You are seeing, yes, earnings season hop into play. You're also seeing M&A in drips and drabs. How do you think about what this means for stock pickers moving forward?
So the catalysts for this market have been for a while, obviously, the AI trade and this enthusiasm over technological innovation. I think that probably continues for a while. Obviously, we're starting a new earnings season very shortly, and we won't hear from those big tech companies for a while, but we start to set the tone with the big banks tomorrow. If earnings season continues to be healthy, if we see at least meeting expectations, somewhere between 8 and 9% growth for the quarter, I think that's part of the catalyst to at least keep markets afloat or even drive some further upside in those big names. The other thing that is working for investors and for momentum right now is that we've gotten accustomed to those big tech names being the defensive play as well. So when we're excited, those are the ones people buy. When we're worried, those are still the ones people rotate back into. So as of now, I don't know that there necessarily needs to be a huge catalyst to move it up. I think because people are starting to feel like maybe we're frothy in valuations, all we need is something that will keep it afloat. But again, come fall, and as this first cut gets nearer and nearer, it's the cuts that are more concerning. It's not always the hikes. So as that gets closer and as we hear from the Fed and what they're thinking, and if they adjust their economic projections in that September meeting, I think the market might have a little bit more difficulty trying to find that durable upside.
All right, Liz, great to get the take from Sofi. Thanks so much for joining us. Liz Young-Thomas there, Chief Investment Strategist over at Sofi. Let's get a quick look at the market, how stocks are moving ahead of the opening bell after a 37th record high so far this year. Yesterday, now we see futures moving back up. They had been down this morning. Okay, S&P futures unchanged, but the arrow is green. Jess Menton, who normally is always wearing green. I mean, what is going on today?
I know, I decided to switch it up.
Jess covers stocks for BN, and we count on you for direction here. It looks like this morning we were going to come down, and now I guess the inflation print has moved us up a little?
Right. So especially if you look at super core inflation, because Fed Chair Powell, as well as other Fed officials, look at that very closely. So if you look at the month-over-month numbers, that still is in a negative territory, actually, for the second time in a row for the second straight month. And actually, it's the lowest it's been since September of 2021. And the reason they look at super core is because it takes out the noise when you're looking at, say, housing, because we know about a third of the weighting in CPI is geared towards shelter. So when you look at that and get a better gauge of what wages look like, you're starting to see it move in the direction that the Federal Reserve wants to see.
It's interesting to talk about inflation today. Of course, we're getting earnings very tied to the consumer,
right,
and it doesn't look so pretty yet. What do we know out of Pepsi in particular?
And that's important because that's something that Tom Barkin from the Federal Reserve talks about as far as watching price to mix. And the reason he watches that is what it means for the direction of inflation. And that's something that companies like PepsiCo and other beverage companies and consumer packaged good companies like Conagra was another one that reported today. Both of those companies saw different issues there, particularly with PepsiCo. It missed when it came to those revenue outlooks that are happening there. And so what happened was it started talking about, it's interesting, their CEO talked about how they're going to start pushing through more promotions. And that's something that Jen Pertashis over at Bloomberg Intelligence has talked a lot about. So say if we're going to the grocery store and you want to buy something for 50% off or buy 2 for 1 and you get 1 for free, that's something that they've talked about that they're going to happen and that they're going to move forward with.
By the way, it's not really a beverage company anymore. I mean, the lion's share of their products, Pepsi, are food products, right?
Right.
It's a good point. It's a good point. We're hitting the consumer from all sides this morning through the lens of earnings, of course. We're talking about a food and a beverage company. We're also talking about earnings. Let's talk about Delta, its outlook missing estimates. It talked about driving ticket prices down, and that, of course, ties into what we learned from CPI this morning.
That's right. I mean, also, this is the first airliner that is going to report, and obviously we're going to have United next week and others as well. So if you're looking at that, it's actually capacity utilization that's been kind of an issue with trying to compete with the demand. If you're looking at the year-over-year period, so you're still seeing strong travel demand, and then you're also seeing when it comes to the business side of that picking up as well, but it's the capacity issue, and their CEO was talking about how it's about an issue of about 3 to 4% higher right now, and so they're trying to make some sort of regards as far as once they get to September, how to sort of mitigate some of those types of problems. But that's what you're seeing in the airline space. So if you're looking at Delta right now, at that stock, DLA is the ticker symbol, down almost 9% in pre-market trading. So you're starting to see that way on other, right? If you're looking at over at United, that's down 4.6% ahead of the opening.
Yeah, all the airlines, I noticed American is off, Southwest is off. So maybe in sympathy. Jess, thanks very much for joining us. Jess Menton from Bloomberg News. She covers stocks for us. We're talking about the consumer. We're talking about earnings. And we should talk about where else the consumer is belt tightening. Electric vehicles is one that we've been watching very closely all year, and it's a capital intensive business as well. Lucid wants to compete with the biggest players. Earlier today, Lucid CEO Peter Rawlinson spoke to Bloomberg about the future of his company.
We are in discussions with others, and when it gets really exciting is you look at the technology that we're developing now for a mid-sized platform for late 26. That really suits mass market family car applications. That's why we're in this. Yeah. We're not here to be a niche player.
All right, let's get to high interest now. A look at what's making headlines around the world. President Biden's re-election bid facing mounting opposition within his own party. Nancy Pelosi said Biden should quickly consider whether or not to stay in the race, even though he already said he's definitely going to. Vermont's Peter Welch became the first Democratic senator to call on the president to withdraw. Axios reporting that Senate Majority Leader Chuck Schumer is also open to replacing Biden on the ticket. And even Hollywood heavy hitters like George Clooney are pressing for change, which is key, not because he's a famous actor, but because he's a big donor and fundraiser. Manhattan's apartment market reaching new levels of competitiveness last month. A record high 24% of leases were signed after bidding wars. That's according to data from Douglas Elliman Real Estate and Miller Samuel. Units were listed for an average of just 24 days before getting scooped up, and rents held fairly steady, but the peak months for demand are yet to come. Tesla shares are climbing at a frenetic pace, but it's becoming harder to argue the case for the bulls. The last time there was a run like this, the rally was supported by revenues expanding at a double-digit clip. Things seem a lot gloomier, though. Now the mood around electric cars is subdued. Tesla's sales are shrinking while profits sag.
Yeah, it's a really fascinating juncture, I would say, for Tesla, because EV demand, you're seeing it being an issue for a lot of automakers. But unlike some of those more traditional players, Tesla is pure play EV. They're not going to pivot into hybrids, for example.
And it's interesting because you've had them on an 11-day run. Today is another make or break moment for them. They are trading at pretty sky high levels here, about 90 times forward earnings from what I understand. And this is one of the longest winning streaks it's ever had. 13, Katie, would make a record.
The market cap is $840 billion. So I think it's always pretty difficult for bulls to make the case at that level, right?
Yeah.
But shorts have gotten super squeezed.
Oh, big time. I will note that it's back to being up 6% for the year. I mean, this was one of the big, heavy draggers in the Magnificent Seven. Now that story is flipped around.
I know the stock is down about 35-40% from the peak in 2021. That's because I read Ed Ludlow's story on Rivian. Let's talk to the man himself right now, because Rivian is trying to convince Elon-phobic car buyers to drop $70,000 or more on its trucks. Now the challenge is to turn a profit. Bloomberg Business Week dives deep into the startup's plan to do that. A new mass market EV, a tie-up with VW, and a battle to find funds as it burns through cash is the story co-written by Bloomberg Technology co-host Ed Ludlow. Ed, it's a fantastic piece, and of course you've been covering Rivian very closely for years now.
Yeah, I mean, it's of lots of interest for lots of reasons, right? Americans love SUVs and pickups. Rivian came out of nowhere to bring the first battery electric 3-row SUV and pickup to market. They're backed by Amazon. They're backed by T. Rowe Price. Like everything you'd want for like Bloomberg Terminal Reader catnip or EV enthusiast catnip. And as we explain in the story, they got off to this amazing start. Loads of these like kind of hardcore Tesla fanboys defected to Rivian because they were fed up with Elon Musk, or they wanted this big EV. They didn't want like little boxy Model 3 or a little Model Y. The problem is then it kind of stops there, and they burn through billions of dollars of cash. So we wanted to just do like the definitive, this is what Rivian's new plan is, and this is how it's going to get itself out of a financial hole.
Well, tell us more about that VW partnership that, of course, made waves a couple of weeks ago. How does that fit into this story? Because a lot of people build that as a lifeline for Rivian. Yeah,
there's a lot of like frenemy status going on in that industry right now. The CEO of Volkswagen was an admirer of Rivian, an admirer of RJ Scaringe. Last summer, RJ met with Oliver Blume, the CEO of Volkswagen, in Atlanta at Porsche's kind of excellence and design center. And when he pulls up into the parking lot, he's like, hey, there are some Rivians in this parking lot. Like, what's going on with that? And all car companies benchmark against others. But, you know, over time they talked. Rivian desperately needs the money, so they get $5 billion over 3 years. But what we report is, A, this is not an exclusive deal. You know, Rivian can talk with other people on technology partnerships, but their plan is to go together with a JV and sell the technology to other automakers. So it's an interesting hedge for VW, and for Rivian, it's like a pretty cushy deal.
a cushy deal, but at the end of the day, Ed, do you expect really traditional car makers to save Rivian at the end of the day and really push their own story forward when really they were seen as such an innovative upstart at the beginning?
Right. Yeah, I think that what we've learned is that Rivian is actually very competent. It's very good at software. It has proprietary design of the key control units within its EVs. Its batteries are great. But it's just not very good at kind of getting there. You know, you guys spoke to Peter Rawlinson of Lucid earlier, and the famous soundbite from here is, "We are not a niche player." I think producer Joe Choffey has a fantastic chart that just tells the story. Lucid is very much a niche player. Rivian is still kind of a niche player. It's had so much trouble scaling, and the market incumbent, all the while Tesla, as told by that chart, has just kind of run away with it for battery electric cars. So the question that the BW story poses and the explanation is how Rivian jumps from that little sliver in the middle of the screen to catching up with Tesla. The VW cash is a big part of that. And the investor belief in them as well.
Ed Ludlow, it is a great piece. Really appreciate you taking some time to talk to us about it. That is Bloomberg Technology co-host Ed Ludlow. Matt Miller, I know you have something to say.
Yeah, because, you know, I have a podcast called
Right.
Hot Pursuit, which you should definitely check out. The Rivian is an amazing vehicle. I mean, beyond the design, which I love, but obviously that's subjective. The tri-motor version has 850 horsepower. The quad motor over 1,000 horsepower. I mean, even though you don't get the excitement that you do from an internal combustion engine,
Right.
the sound, the vibes, the smell, it's so fast.
The emotion of the engine, it's just not there.
You're right, but maybe the emotion of that kind of speed is a winner.
You know what has a lot of emotion? That is earnings season. And coming up, from Doritos to Duncan Hines, a fresh round of earnings are shining a light on a struggling consumer. Details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves on social media this morning. And first up, nothing is certain in life but death and taxes and maybe AI. TurboTax parent Intuit slashing nearly 2,000 jobs as it pivots to AI-powered tax prep software. The company will close 2 of its sites in Edmonton, Canada and Idaho. Next up, we have Apple dodging a bullet, the tech giant avoiding fines from EU regulators after it agreed to open up its mobile wallet technology to other providers free of charge for a decade. Now, under the settlement, European consumers can use alternative digital wallets to pay for goods and services at checkouts. And finally, you're going to have to pay more if you want to shop at Costco. The membership-based warehouse club increasing its membership fee by $5 beginning in September, which is the first increase in 7 years. The charge will impact about 52 million memberships, but the one thing that stays the same is that $1.50 hot dog combo. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check on futures. Will we see a turnaround in equities today? We had futures down at the start of the program 26 minutes ago. Now you can see S&P futures unchanged, up 1/100% as inflation data came out better than expected. Coming up, Max Kettner will talk about it to us from HSBC. This is Bloomberg. Moments away from the start of trading, and we have futures bouncing back and forth. Could we have a 38th record high today? It's possible after that CPI print. In terms of the opening bell, Oliver Wyman ringing the bell right now. They put out a research report on CEOs dealing with this macroeconomic environment. In terms of today's earnings reports, it doesn't look like they're doing such a great job. A lot of misses, especially for consumer companies, and that is why we had futures down. But Katie Greifeld, the CPI print was better than expected. Is it driving the market up at the open?
Not necessarily, maybe at the margins. You take a look at where we stand just seconds into the trading day. The S&P 500, I'm going to go ahead and call that unchanged. Of course, we did shoot higher pre-market after we got those CPI numbers. Not so much right now. You take a look at the Dow Jones for Matt. It's also pretty much unchanged, maybe 0.1% higher if you're an optimist. And big tech actually taking a breather here, falling a little bit at the opening bell. But let's get stock specific here because we have to talk about Pfizer, really higher after the drug maker announced progress on a weight loss pill. That could be a needle-free competitor to the likes of Novo Nordisk and Eli Lilly. You can see Pfizer shares currently up about 1.8%, Sonali.
Also keeping an eye on earnings here, of course. This one's kind of related to Pfizer, though, however. Pepsi now posting a weaker than expected revenue growth this morning. Shoppers becoming more focused on their budgets and health, of course. ConAgra also lowering after issuing disappointing forecasts. Both stocks now down 2.6% on ConAgra and PepsiCo at 3.4% at the open.
All right, so some consumer stocks getting hit. Delta Airlines also dragging down travel stocks after their forecast missed Wall Street expectations. Let's take a closer look with Bloomberg's Abigail Doolittle. Abby?
Well, we have some real weakness for these airlines here, and Delta Airlines putting up a disappointing quarter, especially relative to profits. Profits down 29% on a year-over-year basis, missing the mark at $2.36 for adjusted earnings per share. This has to do with a glut of seats and the rising cost of fuel, less so relative to demand. And you can see all of these stocks are down, having to do with this weakness, the all-important summer travel season. But it's not really a demand issue, interestingly enough. There's just too many planes. So they are working to get capacity out of the air. If we take a look at the S&P 500 relative to the airline index over the last couple of months, today's announcement and the drop, not so surprising to everybody. You can see the S&P 500 in orange here, up about 8% over the last 2 months. But take a look at the airline index, down more than 10% now, down 16.5%. So again, not everybody is surprised by this. I guess we have to see if these airlines can rein in that big supply.
All right, Abigail Doolittle, thank you so much for that roundup. And joining us now for a broader look at markets, we have Max Kettner. He is HSBC Chief Multi-Asset Strategist. And Max, I'm looking through your notes, and you write that we have started a new everything rallies equity cycle. And that sounds very exciting, but I want you to explain it a little bit. Does that mean we're going to broaden out from tech, or what exactly do you mean?
Yeah, I think, look, when we look, for example, today at the CPI report, that's a pretty much an everything or buy everything environment where you can buy, you can buy sovereigns, you can buy credit, you can buy high yield, you can buy emerging market debt, you can buy equities. It's really an environment where growth is not too hot, not too cold, where inflation is no longer seen as that much of a problem as it was perhaps September, October last year, or that little bit of a scare that we got in April. So that really is that kind of backdrop where you're really saying, hey, look, just be broadly bullish across all the asset classes.
You know, we're up, Max. On the S&P, we're up 18% year to date. We've had 37 record highs in a row, which I'm sure everyone's sick of hearing about. But it's just an amazing number because it's the second most this century after 2021. The S&P is up also 57% since the bottom in 2022. At what point do you start taking profits off the table and saying, like, you know what, earnings can't justify this going forward?
So, Matt, there's two things. Number one, if sentiment and positioning really becomes way too stretched, that, I think, is one of the points where we'd be really a bit more cautious. I don't think we're at that point quite yet, because when we look at, for example, our sentiment and positioning indicators, yes, real money investor sentiment has become more bullish, fine. But when we look at our shorter term positioning indicators, things like discretionary and systematic positioning, that is still broadly neutral. It's not even sending even a tiny mild sell signal right now. We're not even at that stage yet. So I don't think really this is the time to pull the plug quite yet. But with regard to earnings, what you mentioned, yes, earnings expectations are definitely a little bit higher. I'm not quite concerned now. I think where I'm starting to get more concerned is from the fourth quarter onwards, when we start to see really the expectations for the broader market ticking up hugely. By the end of this year, by the fourth quarter, consensus is saying that ex-Magnificent Seven earnings growth will pick up to 18% year over year. That seems very, very challenging. It's not something that we can play right now. It's not something we can position for right now. It's probably more for the end of the year, if not even the start of 2025.
You know, it's interesting, Max, you're taking a look at Fed futures swaps, frankly, after that CPI data this morning, and you're seeing a roughly 90% chance of a September rate cut being baked in here. That's still a number of months away, and it's still just one rate cut. And so if you think about the forward look here and any concerns about that impact of higher interest rates, higher for longer, any growth concerns, how do you play that concern into the market that you're frankly so bullish in?
Yeah, look, I guess that is really one concern as well, that the market perhaps is going to make the mistake into that first September rate cut, which we are forecasting as well, and really then trying to forecast or trying to bake in a traditional rate cut cycle. I think back to Matt's point, what makes us more concerned, that is something that makes me concerned as well. So I can see sentiment and positioning becoming much more stretched, much more bullish by sort of September. The market then really trying to sort of brush off the old traditional playbook saying, hey, you know, once we got the first rate cut, obviously that's going to be a traditional rate cutting cycle. That ought to be good for everything. And that's then the time where perhaps you want to sell that first cut.
So what's left out in the cold? Because you think about the traditional rate cutting playbook and you see, for example, bonds rally. You also see small caps rally. But it's something that I keep coming back to because the small cap trade just hasn't worked. And a lot of people have told us to just be patient. Rate cuts will come. They tend to lag that. But then you'll see some of those smaller companies start to benefit. But what's your view over at HSBC about what actually happens to those smaller tiers?
Yeah, so on US small caps, I would continue to be pretty cautious. We've been cautious throughout, really, because the problem with US small caps is, of course, there's a huge degree of companies, a huge amount of companies, almost 40% of them, that are not making profits, that are sitting on negative earnings. There's a huge chunk of those companies as well that are really financed on a floating rate. So both of those things, if we were to get a sudden drop in activity or if yields were to suddenly pick up again, both of those tails would not be good for US small caps. So on that, I still caution. I think when we talk about the small cap trade, I'm more excited about European small caps. Look at the UK GDP number today. It doesn't look that awful. So I think a lot of the leading indicators, a lot of that drop that we had now in June really was perhaps a little bit too much sentiment driven. And, you know, going forward, I think both Eurozone and also UK small caps actually make sense because, yes, growth in the Eurozone on an absolute basis is hardly inspiring. But when we look at how much and to what degree expectations have been revised lower over the last 9 months, it only needs a tiny bit of an upside surprise. And that could really get people already excited about European small caps again.
Hey, Max, this is an equities show right at the U.S. Open. We always obviously cover equities, but you're a multi-asset strategist. You get paid at HSBC for your big picture look. You're overweight high yield credit. What does that mean about your view of the U.S. economy?
That things are broadly still fine. They might not be accelerating, but that's not what we need. When we look at the last 4 years, in fact, when we look at the US economy, it has gone already through 2 distinct default cycles in the last 4 years. So a lot of the weaker parts of the credit spectrum have been wiped out. So in fact, when we look at US high yield, it looks a lot better. When we look, for example, at the share of triple Cs, so the weakest rated companies, that's a lot smaller compared to 10 or 15 years ago. That's actually both the case in Euro high yield and US high yield. So it tells us that broadly, things are still okay. They might not reaccelerate, but they don't have to. As long as really growth is just chugging along, that is great for carry strategies such as a long high yield position.
Max Kettner of HSBC, we thank you so much for being with us, of course, on our launch week here at Open Interest. Now, coming up, it's my happy place. Big bank earnings kick off tomorrow. We're going to speak to Erika Najarian, UBS equity research analyst, large cap banks, and consumer finance, certainly a hot area of the market right now. That's up next. This is Bloomberg.
This is Bloomberg Open Interest. Let's get a quick check on what's going on in markets right now. We do still have red arrows on the S&P 500 and the NASDAQ. So we haven't had a turnaround in the cash trade even after the 8:30 a.m. CPI print came in showing a decline, a contraction month over month, which should be good news in terms of the Fed, in terms of the economy, and indicate that we get a cut sooner than later. Nonetheless, we had a 37th record high yesterday, so maybe investors are selling that news, Katie.
All right, let's get to some of our top calls. The analyst action in focus this morning. And first up, Jefferies cuts Olive Garden owner Darden Restaurants to underperform. The firm said that the chain could lose share if it needs to add more promotions in order to lure those cash-strapped diners. Even still, stock is unchanged. Next up, we have Morgan Stanley cutting on semiconductor to underweight. The analyst says that the chipmaker faces a number of headwinds across its automotive division. Stock a little bit lower just moments into the trading day. And finally, we do have Raymond James initiating coverage of Citizens Financial with a market perform rating. The bank's management setting expectations for weaker net interest income at an investor conference recently. And of course, that bank reports next week, Sonali.
And we're going to stick on banks. JP Morgan, Citigroup, Wells Fargo kick off earnings season for the banks tomorrow. For, of course, the second half of the year, followed by Goldman Sachs, Bank of America, and Morgan Stanley next week. Joining us now with a preview is Erika Najarian, UBS equity research analyst for large cap banks and consumer finance. And let's start with what we have today, because with such a drastic move lower in 2-year yields and 10-year yields, you do see the money center banks being the biggest decliners here in the KBW Bank Index. Citigroup, JP Morgan, Bank of America, Wells, all down on the day. What is the ultimate impact of such a sharp move lower?
So keep in mind that the money centers were huge outperformers so far this year, massively outperforming the mid-cap bank index or the KRE. And so I think the setup today is, oh gosh, September is live. Not only is it live, there's an 88% chance that we're going to get our first cut sooner rather than later. And so this is a bit of a reversal of the trade. Everybody was hiding in the money center banks in terms of higher for longer. And now, given especially the valuation, and if you pair that with, the coming elections, I think you're really starting to see that trade reverse and regional banks get a bid.
It's interesting because you do see already that expectation starting to moderate for net interest income. If you see a move this much lower in rates, does it mean people want to borrow more, or does it mean that there's just more pressure yet again?
Yeah, so let me set up sort of the Goldilocks scenario that I think the market is hoping for in terms of what happens after the Fed cuts rates. So the Fed cuts rates, and then regional banks will get relief in deposit costs. There's going to be some relief in terms of commercial real estate refinancing, at least a perception of relief, and then it's going to be enough to reinvigorate loan growth. I don't know if all of this will happen, but I think that's the initial knee-jerk reaction to the CPI print.
Erika, the other thing that happens after the Fed cut rate, if they do it in September, is we get either a Trump presidency or a centrist Democrat. What difference does that make to these big banks? Because if you watch, for example, Powell's testimony, the Democrats are grilling him on being, they allege, a representative of the big banks, and that's a bad thing from their perspective.
Here's the thing, though. We got two headlines essentially this week that even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks. Chair Powell said he'll repropose that. And there's nothing more effective for banks than time. Second, they're also dealing with changing how to calculate the GSIB surcharge, which is huge, right? Because that could lower the capital requirement for big banks. That being said, if we do have a Trump presidency, that reaction is going to be, gosh, we need to buy the smaller banks because there's going to be potentially, a logjam breaking in terms of consolidation.
And so we're talking to you on the eve of earnings season for these big banks, which is a lot of specific catalysts there. But we have a question from a client saying, shouldn't a rate cut be good for bank portfolios? And that kind of bleeds into a question I wanted to ask, which is, what do the bank equities actually trade on? Because it feels like, again, we're in earnings season. We get some specific news. Maybe they trade on that for a day. But then it just feels like this entire sector goes back to being a macro story.
It always is going to be a macro story. I think that while we can debate on the impact of the first cut, how many cuts, I think at the end of the day, how to get more breadth in terms of portfolio managers owning more banks than just JP Morgan, BofA, and Wells is proving to the market that the risk reward isn't like the reward is underperforming the S&P and the risk is zero. And, that's what you've seen over the past 15 years. You've seen, obviously, the global financial crisis and then last year's regional bank crisis. So it almost feels like for banks to truly pop off, to use a Gen Z term, they really need to go through a real recession and proving that it's an earnings issue, not a capital issue.
Erika, there are some of your rivals here on Wall Street that believe that it is a market for Wall Street, that Wall Street banks might do better than the traditional Main Street banks in this environment because of this rebound in capital markets and investment banking. There's skepticism around that, too. How much do you believe that could really fuel profits going into the end of the year?
So I think there's definitely, I mean, the comps are super easy, right? The activity levels last year were super weak. And so you could definitely see activity levels in banking and equity capital markets, debt capital markets especially, continue to be strong. But I also feel like, the election is such a pivot point. And so you could see, whether it's in loan demand or M&A activity, some sort of near-term pausing. And then once there's certainty, whoever wins, then you could really see 25 activity levels soar from here.
All right, Erika, thank you so much for coming in. Erika Najarian there of UBS, right ahead of the big day for banks earnings. I know it's like your Super Bowl, right? So what time do you wake up on bank earnings day?
Like 3:30. I can't wait. It's like opening presents in the morning.
All right, it will be exciting for sure. Coming up, more financial news, more Wall Street beat for Sonali, a guilty verdict for Archegos Capital Management CEO Bill Wang. That and more. This is Bloomberg.
All right, this is Bloomberg Open Interest. Let's take a look at the markets right now in the wake of that CPI print. You can see the S&P 500 pretty much flat, maybe 0.1% higher, even though you had this big rally in the bond market. 10-year yields down 9 basis points, almost 10 basis points on the day. Big rally there, not matching the S&P 500, but where you are seeing action is in the small cap index. That Russell 2000 screaming higher, up 2%. So the S&P 500 couldn't hold its bid, but small caps and bonds is where all the action is at this morning, Sonali.
And Katie, it's time now for the Wall Street Beat, the most talked about stories in finance. And first up, we have to talk about none other than Bill Hwang, found guilty of criminal charges stemming from Archegos' 2021 collapse. And remember, it's him as well as his co-defendant, the former chief financial officer of Archegos. This was a heated trial. Paul Davies of Bloomberg Opinion asked a good question. Could Archegos happen again?
It's a great question, really. And I think that's everyone's worst nightmare, right? That when you think about the black swans that are still out there, do we have something like that hiding in plain sight? Is there another $36 billion family office that is just being a little bit too risky?
Yeah, I guess it was interesting to see. I mean, the testimony was amazing, right? And to see the relationships between these traders and their prime brokerage, they were so chummy that there was just too much trust, and that's what made it happen.
And some things in the market have changed. Of course, Credit Suisse is no longer really in this market, but some things really haven't changed. They tried to really change up swaps rules. They tried to change up family office rules. None of that happened at the end of the day. So time, I guess, will tell.
And there's some great details, a lot of TikTok that has been in the reporting around this case. I thought this was interesting from the jury. We were talking yesterday about how the judge was saying that both sides were boring the jury, but one of the jurors who asked to remain unnamed, he said that he was on the fence during most of the trial because he worked on Wall Street for more than 3 decades. But he said that Wang, in the end, condemned himself because he was trading on such a large scale and had that manipulative impact on stocks.
Can I just shout out to Chris Dolmetsch?
Yes,
the Bloomberg reporter who covered this did an amazing job. I mean, following what he was doing in the T-Live, and he was covering other trials as well.
He was.
So working around the clock. Chris Dolmetsch, you have to write a book about this trial.
Ava Benny Morrison and Sridhar Natarajan and Miss Relina Golfapoulou, just a total all-star cast. But next up, inside Ken Griffin's Citadel Securities, a strategy for handing even more of Wall Street's trading over to the market maker. That strategy is starting to take shape. It's a nascent strategy, which would have firms deal with clients here. Citadel Security would be dealing with banking clients, while Citadel Securities handles the behind-the-scenes mechanics. It's fascinating, guys, because this is a year in which they're already on track to hit half-year profits, according to Bloomberg's reporting. And remember, this is an extension of what we've seen bank trading desks weakening under capital rules. It ties into the broader story. And Ken Griffin really coming out on top here.
Yeah, really timely story. I mean, just to oversimplify it, it sounds like this is basically white label trading that they're doing, right?
It is, and it's interesting. It reminds me a lot of what other firms like Jefferies and Co. have been doing, because they have been outsourcing trading to other investment banks, while the biggest of banks have more and more constraints, and instead turning to things like prime brokerage, lending to hedge fund clients, instead using those balance sheets when it works.
But it is just another story of these big banks losing business to upstart competitors, right?
You know, this is not quite the same, but you think about just these like synthetic risk transfers that are happening, hedge funds that are taking on loan books from banks, and that's exactly another extension of just banks offloading to the non-banks in a bigger and bigger way.
All right, that was Wall Street Beat. There's always so much to talk about, and we could do like an hour. Someday we'll do an hour show on the Wall Street Beat. Right now, let's get the trading diary, what you need to be watching this week. We'll get more Fed speak from Raphael Bostic today at 11:15 a.m. Then at 6:30 tonight, President Biden holds a news conference at the NATO summit as it wraps up there. That will be unscripted, and it will not be pre-taped. It will be live, so people are paying very close attention. Also paying close attention to JP Morgan tomorrow, plus Wells Fargo and Citi. Those three banks kick off Sonali's Super Bowl, big bank earnings on Friday. And we'll get the University of Michigan consumer data, so more data for the Fed. Coming up, we're going to talk to Steve Eisman from The Big Short, senior portfolio manager at Neuberger Berman. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And U.S. inflation cooling broadly in June, and it's added to the case for a September rate cut.
A conversation with Steve Eisman of Big Short fame. He tells us where he sees opportunities as the bull market leads to lofty valuations.
And the most exciting turnaround you've probably heard of by now. We're going to be speaking to the CEO of Abercrombie and Fitch as the retailer bounces back from the teen fashion graveyard. But before we get there, let's take a check on these markets. Of course, about 90 minutes after CPI dropped, you can see the S&P 500 pretty much treading water here, up maybe 1/10%, if you can call it that. Tech, meanwhile, taking a bath. You can see the NASDAQ 100 turning around from its previous gains, now down about 0.2%, even as that bond market rally continues to build. The 10-year Treasury yield currently down by almost 11 basis points. It just keeps going.
And as we've been saying, the big story of the morning is that inflation print. U.S. core inflation slowed more than expected in June. Let's get more on today's data with Michael Mckee, Bloomberg chief economics and policy correspondent. The market obviously is calling this a massive win here. Odds in September really rising now for that first rate cut. And obviously that's sharp move you saw in the 2-year and the 10-year. How convincing is it all, Mike?
It's pretty convincing, and Wall Street, you're welcome. We're getting you almost there. The Fed looking for more confidence on inflation that it's going to continue to go down, and we certainly saw that today. Headline inflation for the past 2 months has disappeared. It comes in -0.1 this for the month of June, and the year-over-year number is at 3%. Core CPI month over month just up 0.1%. And 3.3% year over year. Those are the kind of numbers that the Fed wants to see. What they really want to see is a broad drop in the rate of inflation, and that's what they got. Some of the categories that moved are the things that you would expect. Gasoline goes up and down. It was down 3.8%. Motor vehicle insurance, it's been a bugaboo, and it went back up again after falling last month. Airfares, we saw in the Delta earnings story, way down. But the owner's equivalent rent is the big news of the day because the Fed's been waiting and waiting and waiting for home prices to start to fall. And we're seeing that reflected in the lowest increase in owner's equivalent rent since August of 2021. So where does it leave us all? Well, you take a look at what is happening in the markets, and you can see that we are now basically priced for a September rate cut, a few basis points short. Probably if we get some decent other news, we'll be over one full cut by the end of the month. Probably too early for a July cut, but September getting priced in. And now look at what we've got for next January, 3 cuts by then. So the market growing more and more confident that the Fed is growing more and more confident and able to cut rates.
All right, Mike, thanks very much. Michael Mckee there talking to us about the inflation data we got this morning, CPI data. Joining us now is Steve Eisman, senior portfolio manager at Eisman Group, Neuberger Berman. He is famous for betting against subprime mortgages in 2007. And Steve, thanks so much for joining us on our inaugural week. Really appreciate it.
You're welcome.
I'm sure everyone always asks you for the next big short. You know, what
Every
else
time.
do you see falling apart?
They want to know, when am I going to predict the end of the world?
Yes.
Is it today?
Well, yeah, look, I predicted the end of the world once. It was pretty awful for everybody. I have no interest in predicting it again, and there's no data to say that it's going to happen, so we should just move on.
All right. All right, let's move on. I was going to ask about CRE, but I guess we can do that at the end. What about this inflation data? What about rate cuts? I mean, how much does that matter to you? I will say, I will preface this with, Katie cares so much about the Russell 2000.
I really do.
She loves the small cap
They're
stocks.
so small.
And they've reacted
But you
very
like little fuzzy
positively.
things? Is that what you like?
Cute little things.
Things.
When are
Okay.
they going to do better?
What do you think about? Do they need a cut? Like, do you?
I don't invest in small caps, so it's not something that I
I guess he
particularly
doesn't.
focus on. So we can move on again.
All right.
I want to move on. I actually do want to move on to the biggest of big names here. I want to talk about Apple because you've
Okay.
talked about it a lot already on our program throughout the year, but you've talked about it in the vein of the artificial intelligence during the longer term. What about the near term, Steve? Apple, the other kind of high flyers you've seen in the market here, what is the case over the next year to be invested in big tech, given where valuations have gone? Do you have to bear some pain in between if you get to that AI?
Well, nobody likes pain. I don't make short-term predictions. I think that's impossible. And the only thing I could say about this,
My iPhone.
your iPhone, is that this looks a little old, doesn't it?
It's very
It's
old.
this is quite old, people.
I don't know if I'm representative of...
The whole point about Apple and AI is very simple. I mean, today, the obvious winners are NVIDIA and the other, what I'd call arms dealers. And then you have, Microsoft, Amazon, Meta, Google, Oracle, people who have big cloud, big database businesses. And after that, we'll see. But one thing that's very clear to me is companies will be doing their AI, whatever they do, in the cloud. And consumers will want to use whatever AI apps are out there, and they're going to want to use it. I'm going to take your phone again, on this phone. And let's be very clear, this phone that she owns doesn't cut it.
No.
Okay? I have the newest phone, so that might cut it for a while. But once there's some apps on that people are going to want to use, you will buy a new phone.
Oh, not until I crack the screen.
Okay, but you're close. I'll buy a new phone, a new iPad, maybe I'll even buy a new laptop. That's what everybody's going to do. It's going to be the biggest, what I'd call refresh cycle, maybe in history.
So before we get there, I mean, you make a really interesting point about, okay, you have sort of the picks and shovels is what people have been calling about it. You have NVIDIA, et cetera. You have data center. People are very excited about utilities right now. What about those downstream wagers? You said that's sort of we'll see territory, but what does the decision tree look like when you're evaluating who could be the eventual users and then winners of AI?
I mean, I think that's a question that is just impossible to answer. I mean, there are no apps. Mm-hmm. I mean, what you're hearing from a company like Accenture, for example, is part of half of their business, which is outsourcing, is doing well, and their consulting business is flat. And why is that? The outsourcing business is where they're doing very well because companies are hiring them basically to clean up their data so that they can eventually then use it for AI. Then maybe they'll get hired to do consulting. So a lot of stuff that's happening underneath the surface is for a lot of companies is cleanup in preparation to be able to use AI. What apps are going to be used? I mean, I don't know. I've never programmed, so I would have the faintest clue. But whatever those apps will be, people will use it. And, for people, individuals like ourselves will use it on our phone or our iPad.
I think even Katie will upgrade. When Siri gets smarter, when AI is really integrated, I think Katie will join that upgrade cycle. You own NVIDIA also.
Yes.
How long-term are you invested? I mean, if I ask about earnings in the third quarter or fourth quarter, I'm sure you don't care, right? Because you're looking years ahead.
Whoa. Don't say I don't care. I care. But do I think that's why I own it? No. I mean, I think this upgrade cycle of what's going on in tech is going to last years. And so, yeah, I think you have to own the large big cap tech stocks. The interesting thing to me within tech, which is a thesis, it's not mine, I'm not smart enough to come up with this thesis, but I think is one of the more interesting theses that I've heard, is that, prior to the last few years, software always outperformed hardware. In the last few years, hardware has outperformed software because of what's going on with NVIDIA. But this argument that's been made is that one of the things that AI is accomplishing is it's crushing the cost of creating software. Like at some point, even you and I will be able to create software.
Yeah.
So if that's the case, that might mean that, one of the reasons why software companies have been so successful is they have these enormous moats. Well, if the cost of creating software collapses, maybe those moats aren't so high.
How long does it take to get there?
Well, that's the question. I mean, it'll be years. But I think if this thesis proves to be correct, what you'll see is a gradual derating of software companies.
But is it so? You want the hardware and you like the big cap. Is it only $3 trillion companies that you like, or what else?
No, I go smaller.
What else besides Apple and NVIDIA?
I think, in bad times, people focus on balance sheets and credit quality. And in good times, they focus on stories. And since I read a lot of comic books, I love stories. So there are two, in equities, two great stories. There's everything having to do with AI and all the tentacles from AI and who benefits, data centers, et cetera. And then there's infrastructure.
Right.
And those are the two dominant themes. Those are the two dominant themes in our portfolio.
But the concentration risk doesn't worry you? I mean, we talk every day about how there's no breadth, right? NVIDIA. Like, does that, everyone's in this trade?
Well, I don't own 100 stocks. I own 30 to 35. So I think you can construct a portfolio where, and there's more to do than just those two themes, but those have to be pretty big themes in your portfolio.
Let's talk about infrastructure, because we are rattling towards the November election.
Yes.
And you've made the point that maybe it doesn't
I was going to bring the
matter.
conversation there if you didn't.
Perfect. Well, here we go, because you
we'll
think
get
about
to debt next.
You think about the Inflation Reduction Act and what that's done for infrastructure. Of course, there's also been an infrastructure bill signed under President Biden. That's obviously created this huge theme around infrastructure. If we get a change of administration, I mean,
well, let's just say
affect...
it's not just the IRA and the IIJA.
Right.
There's onshoring, there's the data centers, there's the dramatic improvement that we need to do in the grid, and there's greenification. So is it possible that in the Trump administration, some of those dollars will be reallocated away from greenification towards some other things? Certainly. Does that mean that the infrastructure theme is dead? Not at all. It'll move to different areas.
Kind of is what you're saying.
Well, the overall theme is Trump-proof. Remember, if you're going to change the IRA, you need 60 votes in the Senate, which is not easy. But could things migrate from green to more traditional energy? That's possible.
It's interesting. On the other hand, you told our colleagues about a month or so ago that by August it would become clearer and it's easier to then start creating trades off of what is happening in the election. We're only a month away.
Yes.
What are you thinking?
100% certainty Donald Trump wins.
Interesting.
Really?
100% certainty.
Is that investable, though? What do you do?
Well, let's talk about why.
Yes.
So forget about, whether Biden's going to run. It doesn't matter at this point to me whether Biden drops out or does not drop out. And this was the prediction that I made a month ago, which is the convention's in August. And that was a pregnant pause, by the way.
I liked it. Yes.
I learned that
We're waiting
40, 30 years ago.
Drama.
I'm taking
keep going.
The protesters that have been on the college campuses are going to converge in Chicago en masse. And what I'm quite sure is going to happen is they'll burn Israeli flags, they'll torch the Stars and Stripes, they'll spew whatever they spew, and the whole country's going to watch, and the whole country's going to be appalled, and the election will be over as they burn those flags.
All down to that.
Yeah,
and that'll
be the final nail.
If Biden gets out of the way and is replaced
matter.
with someone that we all rally around.
I don't think it matters.
Steve, there's another policy issue here, too, and you kind of feel it in the fracturing of the Democratic Party on this issue, is what if the Democrats start to lose some steam going into November writ large? What if you have a red sweep? Are you considering that scenario?
I think that's possible
for equities.
I think that's possible, and under those circumstances, well, there's what's an investment, and what's a trade. So, you had Erika on, who I've known. I don't even want to say for how long I've been Erika and I know each other. So, the regulatory apparatus will get replaced regardless. It probably means somewhat less stringent capital standards for banks, and the banks will all have a nice pop. But after that, I think it's over. I think that's just a trade.
Interesting.
Because I don't think there's a story about why you want to invest in banks like you want to invest in NVIDIA.
Mm-hmm. So it's not investable necessarily, but it's tradable.
It's definitely tradable. My partners and I, we don't really trade, so that's not something that we do. But anybody who wants to do it, God bless.
All right, Steve.
Boy, not done.
Okay. you have 30 seconds.
30 seconds. But you know, other things, you know, whether money gets restructured or maybe there's more onshoring, for example, because of tariffs. That would be an investable story.
All right, Steve, stay with us. Don't go anywhere. We're going to take a quick commercial break. Let's just quickly check on these markets. Of course, not much has changed in the past 10 minutes, but S&P 500 pretty much treading water here, down a little bit. You can see small caps absolutely crushing it. Maybe we'll talk about that more. Anyway, Steve Eisman.
No, we won't.
No, we can talk about it.
Steve Eisman is sticking with us. This is Bloomberg.
The commercial real estate situation, which is, it's significantly downtown office and related retail and things like that. This is something the banks have been working their way through for the last couple of years. I think it'll take more time, more years to work all the way through it. It doesn't seem to be a systemic problem or one that threatens broader financial stability. It does threaten bank profitability and those sorts of things, but it'll be with us a while. We'll just keep working our way through it.
Fed Chair Jerome Powell speaking before Congress yesterday about commercial real estate. Of course, it was one of the most really paid attention to watch clips of the week. Let's get some thoughts here on the sector with Steve Eisman, who's sticking with us, senior portfolio manager at Eisman Group at Neuberger Berman. And you think about these concerns in the real estate market, and even if you don't think it's a systemic risk, what are the continued ripple effects in terms of the pain that investors might see?
Well, I think about 50 to 60% of CRE debt is held by the CMBS market. So that's an investor problem. That's not my problem. That's somebody else's problem. And then maybe 40% is held by banks. Very little of that is held by large banks as a percentage of their assets. You know, some regional banks have significant risk, and it's a problem. But, you know, they're able to pull shtick. You know, as we always like to say in my business, a rolling loan catches no loss. I mean, they just roll it until they can't roll it anymore. So, you know, commercial real estate is a problem that's sort of glacial in that way. You know, there'll be restructurings. Banks will have issues. Some regional banks, I mean, I don't know if any regional banks will go under or not, but it's not a systemic issue.
If I think about the biggest problems facing us, unfortunately, I know that you don't care that much about the federal deficit and debt.
Yes.
But how come? Like, if we're paying more than $100 billion a month in servicing costs, more than we pay
I'm going to take out my violin, okay?
But more than we pay for the military.
Okay,
at some point.
I'll only say a couple of things. Number one, I'm going to put you in the camp of what I like to call the oy the deficit crowd.
Oh. Yes, I'm there. I'm right
there. You're
there.
there.
Me and Lisa
so
Abramowitz.
I'm not an economist. But I understand arguments, and literally every single word that people are uttering about the deficit today has been uttered by somebody for 40 years. Now, in my business, being too early is being the equivalent of being wrong. But I've been a year too early, I've been 2 years too early, I've been 40 years too early. So clearly it's more complicated than the oy the deficit people like to say. You know, is there a point where it becomes an issue? Sure. But you know how you'll know? Instead of on a day like today, where the 10-year is down, how many basis points is it down?
11.
Just 11.
Just 11.
You'll walk in, and it'll be up 50, and you'll say, oh, you're the deficit. And then it'll be relevant.
Yeah, but Steve, this is exactly the same as housing, right? You know, at some point...
40 years. 40 years. Long time. Yeah. It's really just a very, very long. And the argument as to why I think it's just not that relevant, excuse me, my earpiece fell out.
You don't need your earpiece.
Is that it has to be that the fear about the deficit causes people to start to walk away from the dollar. That's the feedback loop. So let's think about that for a second. Why is the dollar the reserve currency of the world? It's actually very simple. Big money has to park its money somewhere. And they're only going to park it in the most liquid, safest bond market in the world. And that's the U.S. government bond market. Until there's actual replacement, the U.S. dollar will be the reserve currency of the world, and what you're talking about is just going to be academic. It's not China. It's not Europe. You know, no offense to all you crypto people. It's not going to be crypto. So until somebody can show up and show me some replacement for the U.S. government bond market, I'm just not concerned.
And it remains to be seen if that'll happen in the next 40 years. But before we get there, I do want to talk about the state of shorting. Of course, you were in The Big Short. Steve Carell played you. Great movie. But it feels like this environment...
That's on my tombstone already, by the way.
It's already carved in.
It's carved in.
It's funny. But in any case, it feels like the state of shorting in this market. This just feels like an environment where companies won't die. And you see these high valuation, high flying stocks, and it just feels like there's a lot of temptation out there to short. But how are you thinking about short selling?
I don't short for clients at all. I short an itty-bitty little bit for myself once in a while. I mean, what I would say to people is, number one, a couple of rules about shorting. Shorting a stock purely because you think it's expensive is a death wish. You have to have a fundamental reason to be short a stock. You know, is NVIDIA expensive? I mean, yeah, it's expensive, but earnings have tripled. So, you know, you could have made that argument a year or so ago, and then earnings doubled or tripled, whatever they did. So, look, I think the economy is fine. Is it slowing a little bit? Sure. Are delinquencies up a little bit in consumers? Okay. But there's no fundamental case to be massively short things. I mean, are there individual stories maybe you could short here and there? Sure. But to go after, you know, the market, I think is insanity.
But, you know, we have the DOJ going after short sellers. I mean, don't they serve an important purpose?
They do serve an important purpose. I don't understand why the DOJ goes after short sellers.
The other thing, too, I believe you were once short Tesla for a certain amount of time, too. What were the lessons learned there? Because you've seen so many people get squeezed on trying to short that stock in this market.
I've been shorted. I haven't been shorted. Look, I think you can at times short Tesla when the fundamentals are deteriorating. And then people stop focusing on the fundamentals and they start talking about, you know, the dream of auto taxis or AI or whatever, and then it becomes impossible. So Tesla's not a stock to be short long term at all.
Steve, we could talk to you forever. Our producers are like yelling at me.
Are they seriously yelling? They're not yelling. Come on.
They're like, commercial break. We got to pay for this. Steve Eisman, thank you so much for coming in. Pleasure spending some time with you. Steve Eisman there of Eisman Group, Neuberger, Berman. This is Bloomberg.
All right, a quick check on these markets. Stocks taking a turn lower. The S&P 500 at session lows right now, down 0.3%. Small caps power on, up about 2.8%, even as big tech down about 1%. Coming up, Abercrombie & Fitch is back. We'll speak to the CEO next. This is Bloomberg. Well, don't call it a comeback because they've been here for years. We're talking about the retailer that was one of the hottest brand names in the early 2000s, and now Abercrombie & Fitch is back. The company has been reborn by strategic investments and a resurgence of 90s fashion, and now the stock moving at a pace faster than even NVIDIA. Joining us now, I am thrilled to say we have Abercrombie & Fitch CEO Fran Horowitz. And Fran, I mean, the stock alone has just been staggering to watch over the past couple of years. But let's talk a little bit about the future from here, because we think about Abercrombie and Fitch, your market is really millennial men and women, but are millennials alone enough to fuel future growth beyond what you've already built?
Hey, good morning, Katie. Thanks for having me, and congrats on the new show. Yeah, so to get right to your question, what's really exciting about the renaissance of Abercrombie is the fact that we have really changed our addressable market. You know, the Abercrombie in the past that people reference was much more of a teen consumer. We've really opened up that space for Hollister and made that the global iconic teen brand. And Abercrombie has truly aged up. The consumer today, they start to shop with us in their early 20s. They still say well into their 40s. So that's a big shift for us that will clearly supports the sustainability of the business. Additionally, we've added so many new categories. The way I like to say it is in the past, right, we were a jeans and t-shirt company, and today we're truly a lifestyle brand.
And I mean, it's an interesting strategy, of course. You think about who was shopping at Abercrombie in the early 2000s. They're now those millennials that are shopping at your store. And I want to talk about how they're shopping, because if you take a look at the margin level, it seems that digital is a bit more profitable than bricks and mortar, for example. I'm curious how you're viewing those two different platforms.
Yeah, listen, both are profitable for us. Our most profitable consumer, frankly, is our omni consumer. That's the consumer that shops on each and every channel with us. We have said for many years that stores matter to this consumer, as does digital. I like to put it as stores plus digital equal magic. And again, just to reiterate, that omni consumer is our most profitable consumer. This customer uses the store a little bit differently than the Hollister consumer does. This consumer does a big part of the business online. The majority of our business is digital, but it doesn't mean that they don't come to the store to transact. That could be to pick up something that they purchased online and popped in to pick up. It could be to do a return or an exchange, see what's new for the day. The Hollister consumer, that business is closer to about a 30% digital business. He and she still see the mall as a very social place with their friends, like to come in on the weekends and go shopping with them. So interesting difference between the consumer.
I'm really interested, Fran, in how you're thinking also about price points here, because you have a consumer. We had inflation data this morning showing that inflation is starting to cool down, but you do still have many consumer-focused companies feeling that strained client. And it's interesting, over the years, a lot of people have gone to Abercrombie and Fitch to do things like go shopping for bridesmaids' dresses for their weddings. Are you finding yourself able to deliver a cheaper option in many ways, or a more affordable option, at least?
Well, to your point, our wedding shop has been a terrific success for us, and that goes back to my point about expanding the customer, both the age cohort as well as the products that they are willing to buy from us and the confidence that they find in what we're putting out there. What we see from our consumer is that when you have the quality and fashion at the perception price that they are willing to pay, they are willing to spend. Coming off of a record Q1, that would tell you that our product voice and experience is lining up really well. And that's true, in fact, what we saw around the world, right? We saw a double-digit increase in our brands, our regions, our channels. So all in, it was really a terrific quarter for us.
The other area that investors and clients are both really watching pretty closely is your expansion in activewear. What is the size today of the YPB business, and who is it taking share from? Is it grabbing share from the likes of a Lululemon or a Alo, for example?
What's YPB?
The Athletic.
So YPB is our performance brand. It stands for your personal best. It's something that we launched in Abercrombie Adult about 2 years ago. And it's a great question, Sonali, because the reason that we created that brand, that sub-brand for us, was because we focus on the long weekend for our consumer. That is what our whole mindset is about. What is that consumer doing on their long weekend? And they said to us, you know what? One of the things that we're doing is we are being active with our friends. We're working out, we're hanging out, and we actually leave your store, go down the mall, and buy this product from somebody else. So we know you can do it just as well, if not better. So we put together a test about 2 years ago. We saw a strong result from it, and we've seen terrific growth from it for the year over year.
Fran, one of the things that led to your success is you used to have sizes that were just for teens or people who are in incredibly good shape. And as you said, you've become more inclusive, and we've, at least I've read, with, good fabrics, a great price point, design obviously are all important. But the stories today about weight loss drugs, lead me to wonder about a resizing in the other direction. Obviously, it's not going to be so fast that you can't keep up with it in terms of your product mix, but do you see that actually making an impact, the Wegovy's and Ozempics, or does it not really make a big enough difference for you to notice in terms of the sizes that you're selling?
Yeah, Matt, to date, we really haven't seen a difference. I understand your question is a little bit more long term.
Yes.
I think the way that we think about it is that the consumer shops when they have the need for something, right? And that whether that's an increased size or a smaller size, I'm excited today that Abercrombie offers an entire wide range of diverse sizing, different fabrics and quality of things. We launched something called Curve Love a few years ago in our denim area for women's. It's almost half of our business today. That's just a curvy individual. It doesn't necessarily mean, what particular size that they might be. So there's always an opportunity for the consumer when they see, again, that price, the product, voice, and experience lining up and a product that they're enjoying and needing, they're shopping with us.
And Fran, I want to talk a little bit about inventory because a lot of retailers, a lot of apparel makers in particular, learned a lot of hard lessons about inventory during the pandemic. It's interesting. If you take a look at Abercrombie, you actually place your orders a few months or weeks in advance for some of your categories. That compares to an industry strategy of about 9 months ahead of time. Do you see that potentially becoming a risk again? If we saw another shock, I mean, how vulnerable does that sort of short lead time on inventory potentially leave you?
Katie, like in anything, we have to strike a balance in our business. So we don't run all of our business that tight. We strike a balance. But one of the biggest lessons that we learned from COVID, to your point, is that you can do a lot more with a lot less. And keeping lean inventory and making sure you're on top of listening to the consumer has been a win for us. Over the past few years, our logistics team has figured out how to make sure that they get the product to the consumer at the right time. So we have a playbook that we continue to exercise, and I'm excited about the agility that the team has built into the process.
And Fran, we don't have much more time left, but I do want to talk about promotions. We've seen a lot of your peers turn to promotions. If we take a look back to your first quarter earnings, you actually reported fewer promotions. When you think about pricing in this environment, a weakening consumer, still high prices, how does your promotional strategy fit in?
Listen, the way that we talk about our promotions, we've talked about this for years, is that we focus inwardly on what our consumer is reacting to. I work with the teams literally every Monday. We have our business review and we go through what's working, what's not working, and we react to the business as such. We do not get influenced with what's happening around the balance of the mall with other retailers. We really have to focus individually on what's working for our business. And back to the prior question with the leaner inventories and making sure that we're testing and we're reading and reacting. It's a matter of just trying not to get too long on things that you don't know a lot about.
Our thanks to Abercrombie and Fitch CEO Fran Horowitz. We thank you so much for joining us, of course, talking us through the strategy on what has been a very high-flying stock. Now we're going to get a check on the markets now with Bloomberg's Abigail Doolittle.
So it's interesting, Chanel, we're seeing something today that we have not seen in 8 days, and that is a down day for both the S&P 500 and the NASDAQ 100. Take a look at the S&P down 0.3%, but the tech-heavy NASDAQ 100 down more than 1%. So we have some real selling developing over, let's call it the last hour or so. The 10-year yield, interestingly, down off of its lows after that lesser than expected, softer than expected CPI print. You would think this would be helping stocks, but given the fact that we were up 7 days into today, maybe just taking a little bit of, chips off the table. Or it could also be the fact that we have the dollar weakening against the yen strengthening up 2%. In fact, let's put this into the perspective of a chart that shows the yen. This is really pretty interesting. So if we take a look at the yen, it's right down on its 50-day moving average. The last time that happened, and it didn't happen in such a decisive manner, we did go down to the 200-day moving average, which in this case would suggest we may be going back down to 151. So that funding out of a cheap yen, well, today it's not happening so much. If that continues to not happen, we don't know that's the case because this support may very well hold. But if it doesn't, we may continue to see some weakness for stocks. As for some of the individual movers, let's take a look at the shares of Delta Airlines because they are under pressure, although also off the lows, down 6%. This, of course, after they put up a bad quarter. Earnings declined significantly on a year-over-year basis. The outlook for the current quarter, very, very weak. And it's not a demand issue. They have too many seats and plus the rising price of fuel pressing on profits. PepsiCo down almost 1% off of its lows. Organic growth up just 1.9%, really missing the mark. Volumes light. Apparently people are eating less salty snacks. I wish that were true for me. And then Pfizer off of its highs, up just 0.5% at this point. But talking about the weight loss drugs, and of course we can't not talk about that one-day pill that they are developing, early stages. Analysts are encouraged, but they say, Katie, more data is needed.
More data is needed. Bloomberg's Abigail Doolittle. Thank you so much.
I got to get some. I'll be a study case for Pfizer on this.
That's perfect. Matt is willing to enroll in any trial you have. Coming up on this program, though, what the fall of the Chevron doctrine means for corporate America. Highlights from our conversation with Kathryn Judge, Columbia Law School professor. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And today, we're examining the consequences of overturning the Chevron doctrine. Wall Street Week's David Westin spoke with Kathryn Judge, Columbia Law School professor, about the potential impact of this decision on banking regulations.
If you look back historically, Chevron was actually one of the key vehicles that facilitated deregulation during the 1980s and 90s. So as you just said, the core idea of the Chevron doctrine is when a statute is ambiguous, that's going to be treated as a delegation to the relevant agency to figure out the best interpretation under the circumstances that they're facing using their expertise. And so in the 1990s, that was a mechanism through which they said, look, banks can actually engage in a far broader array of activities than we previously thought. In the short run, I think banks are celebrating this as a win. Business is celebrating this as a win. Longer term, it's really hard to know. It really creates a lot more legal uncertainty. It does reduce the relative certainty regulators are going to have regarding whether or not their rules are going to be respected. And it puts courts in the driving seat in a way that I think could really shake things up.
Well, just unpack a little bit that legal uncertainty. I mean, I still have a bar card. I'm a lawyer. And so when I read some of these decisions, I thought this is good news for the lawyers because there's going to be a lot more litigation because it's encouraging companies to bring challenges. But we have a lot of courts in the United States, in America. We typically only have one regulatory agency. So what happens when a court in California disagrees with a court in Texas about what the statute means?
I was going to say, presumably it's going to have to go to a higher court, and that is precisely the right question to ask. So now when a regulator comes out with a new rule in advising their clients, a bank regulator or bank advisory attorney is really going to have to engage in a two-step analysis. First, here's what the regulator is saying that you're allowed to do or what the requirements are. But second, there's a lot of legal uncertainty. So whether or not that's going to be the rule at the end of the day is going to take a significant amount of time to actually become resolved. So it certainly means that there's just going to be a lot more uncertainty in the bank regulatory environment in the years ahead.
So I'm going to ask you do something you're not going to want to do, is just speculate, but we don't know. But you teach regulation and legislation with respect to particularly financial institutions. As we look at various regulations that are pending, including the Basel III, but not limited to that right now, do we think that may affect the way they go about making their rules? Because now they're very conscious of the fact they're going to have a court of some sort looking over their shoulder right quick.
Yeah, so two things. One, I think it's certainly going to affect the way that they undertake rulemaking, Basel III and otherwise. That's partly because, again, Loper Bright just overruled Chevron, but there were also a number of other significant Supreme Court decisions that really allow courts to scrutinize far more closely the decisions that regulators are making and the processes through which they're making those decisions. So there is a risk it's going to make regulators a little more gun shy and a little more worried about making sure they've crossed every single T and have dotted all of their I's before they promulgate regulation. That being said, bank regulators are also bank supervisors, and they have an ongoing duty to really promote the safety and soundness of the institutions that they oversee. So you could end up with a world where if regulation is not able to keep up with potential changes in market dynamics or risks that supervisors are seeing, a lot more work gets done through that supervisory process which is far less transparent and far less uniform.
Well, so this is a fascinating point I had not really thought about. It may shift away from the regulatory approach where they have a notice and comment, everybody comments on it, we know what's going on, as opposed to, I'll call it prosecutorial discretion of a sort, through the supervisory function. That's a very different kettle of fish.
It is a very different kettle of fish. It's one banks have had to deal with for a long time, but the question is relative importance. One of the ways of understanding Chevron, particularly as it's been narrowed in recent years, is it created a real carrot that really encouraged regulators to undertake notice and comment rulemaking, which is a very time-consuming, very resource-intensive process, because at the end, they knew they were going to get this carrot called Chevron deference. Now that you've taken that carrot away, it puts a lot more onus on the regulators to think, well, what is the right tool of the various tools I have available for trying to achieve a particular end? It still might be regulation in some set of circumstances, but it could also be supervision. For banks, it could be things like the living will process that we've seen being a mechanism through which you get kind of change over time. It could also, for something like the CFPB, be policymaking through enforcement. Rather than clarify what certain terms mean, use enforcement policy to be a mechanism through which you make policy. So again, I think it certainly changes the world around regulation by rulemaking, but that doesn't mean long-term it's really a win for business.
And that was Kathryn Judge, Columbia Law School professor, and of course, Wall Street Week host David Westin, who joins us on set now. And I'm so glad you did that interview. Fascinating to listen to because it's hard to untangle all the different implications that this could have. But you make the good point that it's probably good for lawyers.
Well, that's the most important thing, of course, that the lawyers get paid. No doubt about that. But this is the most important law in all of Washington, which is the law of unintended consequences, because the Supreme Court's been sort of on a campaign of cutting back on regulatory things, which include Chevron, other decisions this term actually as well that really cut back on it. And they think that's going to help business. Actually, we had Ken Jacobs from Lazard on last week, and he said, look, as an advisor in M&A, I think it makes it more complicated because I'm not sure what the rules are.
That's exactly what my mind went to. What does it mean for example, the FTC? Because you're sitting here with a Capital One Discover deal where things have been extraordinarily silent, and then you have this issue with the Supreme Court and the Chevron doctrine. So how far does this go?
You know this world so well, Sonali. As a practical matter, if you're deciding on a deal and you go and you ask your advisors, how's it going to work? It increases the time involved, it delays things, and increases the friction, which actually increases the cost of the deal, if I can put it that way, because you may prevail ultimately, but you don't know when you're going to prevail or how much you're going to have to pay in the meantime. But most important, because I've been on the receiving end of this, if we delay that time when we actually put the companies together, a lot of mischief gets done.
Congress is still going to want to regulate, obviously. How will they deal with this, in practice? Are they going to have to explicitly specify the people that they want to oversee their rules?
Going to have to. Can they is the question, Matt, right? Yeah. I mean, that's also like the important question doctrine, which also the court's been dealing with. And that's a great theoretical point. But look at Congress, what it gets done and what it doesn't get done. To your point, Matt, it has to do it, but I'm not sure it can do it. And if it can't do it, it sort of doesn't matter.
So a lot of big questions to noodle on. At least got some answers with Kathryn Judge. Who else do we have coming up on Wall Street Week?
Well, we're going to talk to Scott Besson. You know, Scott is very much in the news these days because he's talking to former President Trump fairly regularly. We're going to talk to him about exactly what a Trump 2.0 economy would mean and what it means for business. He's got some pretty outspoken views on that.
All right, a lot to look forward to there. Our thanks, of course, to Bloomberg's David Westin. This is Bloomberg. Let's take a quick look at some stocks hitting highs this morning, and we start with Citizens Financial hitting a 52-week high after it was initiated at Raymond James as a market perform. Of course, it reports next week. It's going to be interesting to see how that one goes. We also have Republic Services hitting highs after it was raised to a buy at Truist Securities. That's good for about a 0.6% rally. And this was a high, and now it's coming back a little bit. But you have Corning hitting a high earlier after its price target was raised to $50 over at Oppenheimer. But currently, Matt, down about 1%, I'll call it.
All right, interesting individual moves. Let's get to the trading diary, what you need to be watching this week. We'll get Fed speak from Raphael Bostic today at 11:15 a.m. Then at 6:30 p.m., President Biden holds a news conference as the NATO summit wraps up. It will be live. It is not scripted. It is a big deal, I think it's safe to say, for the campaign. Tomorrow, we get big bank earnings, really kicking off earnings season in earnest. JP Morgan, Wells Fargo, and Citi will kick off. Sonali is going to be coming in at 3:30 in the morning and spending the entire day here.
4:30.
We're going to get University of Michigan consumer data as well, so maybe one more piece for the Fed to ponder. But Sonali, what is the most important thing that you're looking for tomorrow?
Well, even the setup, right? You have a lot of the banks ended lower on the day, but now really taking their foot off the pedal, investors are here and starting to flip a lot of those banks back into green territory. Excitement around potential rate cuts coming into the market.
I have to say, I'm still more excited to see when the regionals really start going.
Yeah.
That remains the really important story for me.
I'm kind of excited not to have to watch all of them with that much closeness, but I am
feel
also
like
excited
if you
for
get
them
the big
as
ones
well.
out of the way, then you can sleep until at least 4 or 4:30. All right, that does it for us.
Yeah, coming up, we have Bloomberg Technology, but that does it for Bloomberg Open Interest. I'm Katie, along with Matt and Sonali, and this is Bloomberg.